Joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market's performance. Jason, thanks so much for your time this afternoon. So earnings in focus, and let's start stateside with Nvidia's second quarter numbers. I never know what to make of these earnings, Jason. I mean, headline after headline, you read bumper numbers, market-beating numbers, but then you look at the share price and it's ticking lower. What's going on there? What are we not understanding?
Well, it's always a bit of a head scratcher, and actually probably laughable when you're reading articles talking about tepid revenue forecasts for the next quarter that are in excess of $50 billion, right? I think it's kind of reflective of where we are in the cycle now when it comes to AI and US tech. I think if you dig into the numbers, it looks like a decent set of numbers. No revenue coming out of China. But the reality is, when the bar is set so high from an analyst expectation point of view, it becomes problematic for these companies to continue hitting and exceeding expectations, like what Nvidia has done over the past couple of years. I mean, if we look at expectations and what they are forecasting for the next quarter, I mean, where we're at now, even though we've got earnings and revenue up, but one mustn't forget that about a year ago, revenues were doubling, even tripling. So it's kind of this law of diminishing returns from a revenue perspective, as the build out from AI does seem to be, although increasing, does seem to be slowing somewhat quarter over quarter.
All right. I mean, you'd expect that even with, I guess, some of the other big tech companies increasing capex spend on AI, that perhaps that would, filter through when it comes to sentiment around Nvidia. But I do understand that maybe we're not now at those triple growth levels, but maybe now we're at the double growth levels. All right, so let's move over to some local company news. At home, Harmony Gold posting double-digit earnings growth, benefiting, of course, from that higher gold price. The share price, however, the last time I checked, was in the red. What's the reason behind that? Did markets expect better numbers?
Yes, absolutely. Again, almost a similar theme. It was well guided for, but to be fair, it is a bit of a poor update relative to analyst expectations. Headline earnings per share was 22% down versus consensus. The miss on the dividend is probably what's weighing on the stock at the moment. The reality is gold production is down, lower realized price per ounce, as well as costs seem to be rising, which the market is not enjoying.
Moving over to another subsector within the mining industry, that being PGM. Implats posting a 70% decline in headline earnings amid lower sales volumes, but the miner seems to be positive about its prospects. Has the tide turned for these PGM players, Jason? Just looking at what the platinum price has done so far this year. I mean, even just looking at some of the platinum players and the share price movements we've seen on the back of those prices.
Sure, that's a bit of a loaded question given what's happened to PGMs over the last few years, but it does seem that from a price perspective and global demand, it does seem to be starting to turn a corner. I think in Impala's case, the dividend is a bit of a surprise, which is probably what is supporting that share price today. However, outlook is somewhat disappointing. I mean, this theme of production down, costs up, higher capex, never really that great. Costs are forecast to be up about 4 to 9%, but I mean, if we take previous guidance into account, that's more like 12%. So again, where you in the mining space, where you've got these elevated commodity price levels, however, cost control does seem to be a bit of an issue here.
All right, let's move over to the poultry sector, where Rainbow Chicken's earnings more than tripled as its strategy, of course, starts bearing fruit. But it's warned of risks, of course, right? There's those US tariffs in play. There's also a possibility of even further outbreaks of the avian flu. Really a volatile sector to operate in, because, I mean, you even think of the likes of an Astral that have warned of similar risks.
Absolutely, and I think it shows you when you get these periods where the avian flu is less of a risk. And hasn't really been around. You can see in the numbers how good it is. However, yes, it shows you how much easier it is to run an energy-intensive business when Eskom's actually providing the electricity. So a real big beneficiary of that. And yeah, their turnaround strategy is progressing well. I mean, yes, earnings are pretty well guided, but yeah, very strong reaction to the results.
And from a sector that's volatile to one that's more defensive, Jason, the education sector, we've got Stadio, of course, posting double-digit earnings growth as well on the back of strong demand for, its services that it offers in its tertiary institutions. The numbers expected, right? I mean, there's a lot of runway for growth when it comes to these counters, the likes of Advitech as well, with numbers earlier this week. I think those numbers also coming in good. What we are seeing, though, is, downbeat growth in the schools sort of department when looking at the numbers from Curo. Just your sentiments around that sector, and then we can get your analysis of what you thought of the numbers out of Stadio.
Yeah, look, it is a high quality sector to invest in, private education. But yeah, look, I mean, again, from a broader sector perspective in terms of consumer being under pressure,
yes,
and fees surrounding private schooling, it is tough out there. I've been on here before talking about how South African consumer in general is under a lot of pressure. But at the same time, then it comes back to when you're seeing results like this, businesses like Stadio are kind of able to well guide and hit their guidance. And yeah, still on track for their pre-listing forecast of 56,000 students by the end of next year. Seem to be executing well. The Durbanville campus remains on track for opening in early 2026. So I think, yes, while the sector itself might be under a little bit of pressure, particularly around the high school component, it does seem like the likes of Stadio are managing to operate quite effectively in the sector. Yeah.
And, we talk about a consumer that's under strain, but it's also interesting to see how resilient the South African consumer is and what the South African consumer chooses to put its money in, right? So things like education really seem to be important for the SA consumer. All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what counters your industry peers are watching closely.
I'm going for the upside. The bar is very high, and so far they haven't let us down. I love the company, and I'm hoping something comes out there that will, make investors celebrate. I'm just looking at the outlook. The target prices still remain very high. Analysts still remain very bullish, so I'm going with them. And it's more I'm talking my book than anything. But I'm very nervous. So. We're always nervous when we have these big events, that they actually do what the analysts expect them to do.
Going first, Rand. Yeah, they recently had they won this UK Supreme Court case, where against that motor finance commissions. That was overturned. That is positive. I just think in general our banks are still on the cheaper side. When we look at it on a forward, or let's call it a historic price to book basis, where they're currently trading around about the two times. It's still on the cheaper side for FirstRand, trading at an ROE of 21%, nice dividend, and I think a little uptick in our economy could just do the world of good for our banks. So I'm doubling down on SA banks, and definitely FirstRand is one of my better picks.
All right, Scott going with the banking sector here at home with FirstRand as his pick. David, of course, picking Nvidia. I love how he touched on the nervousness we see in markets just ahead of those numbers. And listen, hey, we saw it play out. We even spoke about it at the top of the show, where we saw that share price coming in the red in extended trading. Just your thoughts around FirstRand, I guess, because we've talked about Nvidia.
Yeah, sure. Look, I think now experience trading, investing in South Africa in particular, what we've learned is in banking, you should be paying up for quality, and First Rand is arguably the highest quality bank in South Africa. It generates high ROEs, and at the same time will probably be a beneficiary of the capex outlay in turning around Transnet going forward.
Oh, that's interesting. That's very interesting. All right, let's take a look at what your stock pick is then. Where are you seeing opportunity today?
So my pick today is Glencore. This is a company that's been beaten down by economic concerns, weaker coal prices, and to be fair, some production and volume misses. But we think it's an absolute steal at the current share price. We really like the trading business, and we think that the current environment that we're in with all these disruptive trade flows and this less than ideal macro environment is actually ideal for the trading business to print money, and this part of the business at least shouldn't be valued like a mining operation. And yeah, look, I mean, we also like the future metals part of the portfolio, the likes of copper, cobalt, nickel, and yeah, I mean, we can easily paint a very nice demand profile for that going forward, and they even produce a bit of gold. But yeah, it definitely doesn't trade like a gold stock.
All right, let's leave it there, Jason. Thank you so much for joining us this afternoon and taking us through trade at midday. Now, that was Jason Horn from Steyn Capital Management.